Hey guys, today we're talking to the number one REO agent in all of Illinois, and in terms of volume, number 4. So this guy knows what he's doing when it comes to foreclosures, when it comes to distressed properties, and obviously he's the number one REO agent. So Ryan, let's get started, man. So, Ryan, let's talk about, just to set the stage.
Yeah.
What is an REO agent?
So an REO agent, REO is an acronym for real estate owned. It's bank-owned properties, in essence, right? Mortgage servicing companies and banks. When a property goes to the foreclosure sale and the reserve is not met, the mortgage servicing company or bank becomes the new owner of the house. Then it becomes an REO from that day forward. So real estate owned is what it stands for.
Got it. So basically, it's real estate owned, and so these are properties that were in foreclosure. Now they went to an auction, sheriff's sale. And at the sheriff's sale, they did not sell to a third-party buyer, like me.
Like you, yeah.
Right, correct. Yep. Now they have sold to a bank.
They reverted back to the bank. So at the foreclosure sale, the servicing company or bank, they set the reserve.
Right.
Be what number it is, and if it doesn't hit that and nobody buys it, they get the property back.
Got it. So that makes sense. So you handle,
and I'm sorry, I say that because people are often under the assumption that, well, once a sale for $180,000, that's what's got to be owed on it. We'll buy $180,000. That value has nothing to do with the real value of the house. So they don't buy it back. It reverts back to them.
It reverts back. So basically what happens is that the bank gave you a mortgage, the seller, the buyer of the mortgage,
right.
And the buyer, for whatever reason, was unable to pay. They took them through a foreclosure process, and as a part of the foreclosure process, they acquired the property, right?
Correct.
So a lot of times, I guess the first thing that you just mentioned was it went to foreclosure, let's just say for $180,000.
Right.
Right. A lot of times people have this misbelief. Well, but the bank got it for $180,000, so I'm offering them $190,000. What's the problem?
Yeah, we get that a lot. I have a lot of times people call and say, "Well, we looked at the mortgage history, and they took out a mortgage in 2015 for $200,000. So I think if I give them $170,000 today, and the fact of the matter is these mortgages have been bought and sold so many times, right? If you take a mortgage out today, that bank, chances are they're going to sell it within the first 90 days. It sells again and again and again. The value of the mortgage has nothing to do with the house, right? Just like you want to make money, the banks are in business to make money, right? They buy mortgages with equity upside to them. So
correct.
Yeah, the previous balance, what was owed on the house, trying to get it off the bank's books. That's all talk, I think, from maybe 30 years ago.
Right. Correct. Yeah. I mean, that's not how it works today.
No.
Right. These banks are not. I mean, it's simple supply and demand.
Yeah.
Right. So let's just explain that. Meaning, how does that work? When you have a lot of foreclosures that a bank has, they're going to offer you a cheaper price.
Right. Well, it has to, supply and demand, it has to do with the market too, right? Too. The bank, look, they don't. I had somebody call me the other day. Say, well, I'll give you the house listed at $225,000, $250,000. I'll give you $100,000 just to get it off the book. Look, the books are irrelevant at this point.
Right.
By the time it comes to me, there's no book, there's no profit and loss page that you're looking at. That's irrelevant. These are distressed properties the bank is moving, but they're trying to get some money back. The reason it's in a default is because they didn't collect a yield, they didn't collect a mortgage. They've lost money on this property.
Right. From
paying property taxes, and they took a risk. They lost their investment. Lost, right? Giving somebody a mortgage is an investment for a bank that lost. So they come back to us, and the supply and demand issue is there's not a supply in the market right now, right? There's a demand, but there's not a supply. And we look at the foreclosure numbers at the foreclosure sale, at the county sale, and our foreclosure numbers are down. In October, we'll probably have 160 to 170 properties revert REO. On average for the last year, we've been seeing about 140 to 180. Prior to COVID, that number was 450 to 500, right? So we're down to 60% of foreclosures coming to the market. So that creates a hole in the market. There's not an inventory there. So the demand is a little higher from a value add standpoint. There's not a lot of stuff out there going on the markets. When it does go on the market, It creates a high demand if it's in the right markets, right? And
Right.
we're
So
seeing a lot of correcting markets now where we're having challenges moving some of this stuff.
So it's been interesting, right? Because the market in 2019, I remember this conversation with you, right? We're like, man, the prices are crazy,
Yeah.
right? I don't know how it goes any higher. And clearly, 2020, nobody could have predicted what happened,
Right.
right? Which is the market came to a dead still, and then it shot through the roof, right?
Yeah.
Because we just printed money. It's like people are like, well, the property prices went up. No, no, no. The property prices didn't go up. What happened was we devalued our currency because we printed so much of it, right?
We've been devaluing it for the
And
last
we've been
couple
devaluing
years.
it. And so basically what that did was pure inflation. Right?
Right.
People are like, well, the property, yeah, of course. If you own properties, your properties are worth more because the dollar is worth less, right? So it's not a true appreciation in the market. It's just that what $100 buys you is less stuff.
Right. I mean, you look at repair costs, right?
Right.
In 2020, you could go into a 1,300 square foot 1958 style ranch, 3 bedrooms, 1.5 bath, and you could rehab that house for 75 to 85,000 all day long. You can't touch that house today for 115 is going to be your rehab numbers. You know, so I mean, the dollar depreciates, the cost of everything goes up. You know, I get people tell me, "Oh yeah, I can rehab that house for 60,000." How, where, when? Show me how. You just can't.
So let's kind of talk about the dichotomy of the real estate market, actually, right, in terms of Chicago. And then I want to kind of talk about the process when a property comes to you, what you go through, right? So we were talking about kind of the example we use, which is the tale of two cities, right? Chicago is a massive landmass in terms of area-wise, right? And it's almost two different markets. You have the market which is not doing well, and then you have some markets that are doing great. So let's start with which markets are you seeing trouble in?
Sure. Well, we'll take downtown. When I say downtown, West Loop, we'll take that kind of to the side.
Of course. That's a different market.
That's a different market, right? And I'm talking more from Western Avenue West, 55 South, and then you go north up to Jefferson Park and all that. So if we start north, if we look at Jefferson Park, Norwood Park, Edison Park, those markets are untouchable.
Right.
It goes on the market. There's multiple offers. Those houses are being sold quick. If they're on the market for more than 30 days, they got a weird floor plan. There's something choppy with them. That's Jefferson Park, Norwood Park, Edison Park, which is kind of like a suburban area out of Chicago. A lot of city employees working up there. That's a very hot market. We come a little south, we get into Belmont-Cragin, which has been a very overinflated market.
Correct.
Belmont-Cragin is, the bungalows were selling at $450,000, $500,000, $600,000 because they were kind of jumping off the Jefferson Park values, and those values are starting to come down. The further south you go into the west side, those values are really starting to soften. And same with the south side, inner city south side. Your Chatham, your Auburn Gresham, your Inglewood, your Roselands, you're going to have a lot of frame housing stock down there, but all those markets are really suffering. We're not seeing the values we saw a year ago, even 6 months ago, right? A lot of our REO stuff is on the south side is between 85 to 110 if it needs a complete rehab. If it's cosmetic stuff, we'll be in the 140, 150 range. Where a year or two ago, those were 125, 135 as is. Renovate was 350, 360. Those renovated values are now 275 to 295, and they're shifting downward. It's a very payment-friendly market. When I say payment-friendly, buyers don't buy on cost of the house; they buy on what their payment will be, right?
So hold on, let's explain that a little bit, right? In A area, B area, right, where you have higher price of housing, where you have a lot of people that make a good amount of money, they're buying a house, right? Meaning, if it's 600 or if it's 650, they'll qualify for either, right? Now it becomes this that, hey, do I want this house, right? Whereas as you go to certain areas, people are buying a payment, right? Hey, I can afford $2,200, but if it's $2,350, no, that's not something that I can afford.
And a lot of these buyers are FHA buyers, right?
Right.
And they don't put a lot of money down. They ask for the seller to contribute their down payment and a closing cost. And with the rates staying where they've been, I mean, they dropped a quarter point, and people got really excited, but really they didn't move it. I mean, it's not doing much. If property taxes going the way they are, the payment affordability for these buyers in these BC markets is putting a strain on them, right? And you're having more inventory out there on the back end. There's a lot of back end inventory that's not moving.
Right.
On the south side, if you look at Chatham and Auburn, Gresham. And the same thing on the west side. You see that as well. Multi-unit pricing is starting to come down just because the property taxes aren't making sense anymore.
Right. So, I mean, we're seeing that. So you're talking about like South Side, which is for people who are in Chicago, South Side is in the city of Chicago. And then we go to South suburbs, right? We're seeing that in South suburbs. To me, in some cases, the South suburbs, certain places where the taxes are high, right? And this is directly related to taxes that, say, 2 years ago, tax on the property, $6,500, $7,000. Today, it's $9,000, right? And think what it does to a average buyer. Right? And values have gotten killed over there. We're almost like South Holland's a perfect example.
Yeah.
Great area. Starbucks goes in there, so they see upward mobility in some places, right? Clearly. But yet, a tri-level type of a property, a nice big, 1,900 square foot property 2 years ago, two and a half years ago, would have sold for $310,000, $315,000. Now, that property is only going to sell for maybe $280,000. $290, right? And people don't realize that's almost 15% off, right? Your back end values. That makes a heck of a lot of difference when especially if you're investing or if you're a homeowner.
Especially if you're investing with hard money, you're using private money, because that 8 to 10% juice that you're paying them, that's your profit, right?
Correct.
And a large factor of it is property taxes. If I was just at a conference in Dallas talking to my mortgage servicing clients, the number one leading factor defaults in Cook County is the tax escrow.
Right.
It's not the mortgage payment. Their tax escrow over the last 3 years have made their mortgage unaffordable because they buy on payment. They don't have the money.
Just explain that, because a lot of times people don't realize that what does tax escrow mean?
Right. So when you take out a mortgage, you have your property taxes. I'm going to use an easy number. Say your taxes are $12,000 a year. It's $1,000 a month you pay. So say your mortgage is $2,000, your taxes are escrowed into your mortgage. So the mortgage servicer is paying your taxes, you're just collecting them in the mortgage. So your payment's $3,000. We're using the easy numbers. If that $12,000 jumps to $15,000, your payment changes by $350, $400 a month. You can't afford your mortgage anymore. You're having a tough time making your payment, and it's falling behind. So that's the reason they're pushing in default. They might be able to afford the principal and interest, but they're no longer able to afford their tax escrow. Because when they've qualified for the loan, they can afford $2,000 a month. They can't afford $2,500.
Right.
And $500, people might list say, well, that's not. It's a big deal out here today.
Right.
Because of inflation, because of where the dollars went. $500 extra for a family of four in a $250,000 house, that can break them.
And also, it's paired with a couple other things. The interest rates haven't helped.
No.
The taxes have gone up. Insurance has gone up, right? And on top of that, we're in a weak economy, right? Economy soft. So there's a host of this. So all four things that can go wrong has gone wrong. Right? Because a lot of times when things are good, right? Economy strong, everybody has a job, blah, blah, there's just money flowing. As soon as the economy starts cooling down, who loses their jobs first?
Right.
People who are generally, workforce neighborhood, which is your blue collar people who are generally in a little bit lower economic bracket, they're going to lose their jobs, and that's going to reflect in foreclosure numbers.
Yes, and the addition is crime.
Crime, yeah.
And people that can afford to move have left.
Right.
People that have had equity in their homes have left. And people say, well, I read the national news and homes have equity. Values, guys, homes have equity on a national front, not on a Chicago front.
No. Yeah,
because you remember, to have equity, you've got to put 20, 30% down when you buy the house.
Right.
And then you've got to continue not refinancing, not taking money against it, and continue to make your payments. But when you buy a house at $420,000 in Belmont Cragen, you're at the top of the market. You bought that house 4 years ago on an FHA loan with a 3.5% credit. The seller paid your down payment. You have no equity to sell. So when that 425 house is now 350, you can't. Where are you going to go?
Right.
So the people and another reason is crime. Crime is pushing people out of Chicago.
Right.
At alarming rates.
No, I mean, and that's so true. So, I mean, that's where kind of, to me, that's where the Tale of Two Cities begins, right? Because it's interesting because I've been talking about mobility areas lately, right? So sometimes what people will kind of, people like to, put everything in one bucket. And you can't do that, especially with a place like Chicago.
No.
Right? No. Because there are so many pockets. And even in the city, there are so many pockets that you may have a pocket like Archer Heights, right? You may have a pocket like around that Midway area.
Yeah.
Around some of those pockets are doing well, but the property has to be priced right.
Right, and like by Midway, if you're in that area of 63rd and Central,
Right.
59th and Central is a lot different than 64th and Central
Correct.
from a value standpoint. If you go to Western Avenue and you look at 59th and Aberdeen and 59th and Justine,
Right.
you're 5 blocks away.
Correct.
Western's a big thing. That house on Justine in Inglewood is going to be 30-40% less than the house on Aberdeen, which is right there.
Right.
So Chicago is a block by block market.
Correct.
And that's one of the reasons a lot of institutional funds don't have success in Chicago.
Right.
Because institutional funds have success in markets where 3-bedroom, no basement, 1,800 square feet, every house is the same, and the model fits. Well, we have basements. Our square footage is different. Our blocks are different. Our neighborhoods are different. You can have one block with gang activity. The next block is a block club with senior citizens that the gangs won't enter. So that bungalow is going to sell for $30,000 more.
Right.
Than this block. And you really have to know that being in Chicago. It's,
right. And that's the interesting part. Now, how do you feel the market is in the suburbs of Chicago? Right, so you look at the western suburbs, you look at the northwest suburbs, right, or the northern suburbs. What's your feel for that market?
Those markets are doing very well. They're performing very strongly, but those markets also are people that have means, right? They can leave the city. A lot of times, if you come to Oakbrook, if you come to Downers, if you go to Schaumburg, those people are putting 20% down, 15% down, and they can buy the rate down fairly easily if they need to. Right, so if the rate's at 6.5, 7, they can pay an extra 2 points to get that rate down, where it becomes more affordable to offset some of the things. And again, people are leaving the city due to crime. They're coming to the suburbs where the demand is still high. So things in the suburbs are moving at a rapid rate. And there's an inventory. There's a supply and demand issue.
What's interesting is, and this is something we're seeing, that if you are in areas where the taxes haven't gone crazy, the affordability is there, right? People are buying houses. Now, obviously, it's not as many multiple offers, of course, right? So it's not like, oh my God, no, everything is great. No, but I mean, we're much more at a very reasonable market in those areas, right? And which is a good northwest, going out west, right? The markets are strong. And what is interesting to me is that if you look at the Maywood market, man, it's strong. Right? Look, I mean, you look at Broadview, you look at Bellwood. It's crazy.
I can't believe the numbers we're getting. I just did a valuation on a bungalow in Maywood, brick bungalow. Needs everything. The windows were boarded by. I mean, this is a REO all day long, nothing salvageable. I'm going to list that thing for $149, and I'll get multiple offers on it.
Right.
Brick bungalow corner, but $149 in Maywood. I mean, that's crazy, but we're getting it. And there's no inventory out there to help me get a lower value.
Right.
I can't justify anything lower.
Right.
I'm pretty good at 149. I could probably go 164 and test it, but Maywood's a crazy market right now.
Right. And that's the interesting part. And to me, that's what is exciting about Chicago, that if you understand the market, you can do really well.
Yeah.
But if you don't, you can get caught with your pants down.
And, we're talking Maywood. If you go 2 miles south and you're into Berwyn.
Right.
Now you're a lot softer.
Exactly.
Berwyn's, and you would think if you looked at the two on paper,
Berwyn would be a stronger
would tell
market.
You Berwyn would be a stronger market.
It's not.
Maywood is a stronger market than Berwyn.
Yeah.
Which it's Chicago for you, right?
No, but there's a reason behind it, because what happened was that a nice bungalow at one point, right, in Berwyn, fixed up, was like, man, $350. It's crazy. Now, even at the price that has slid down to, still they're selling $430.
$430.
Right? I mean, it's amazing.
And They shouldn't be.
They shouldn't be. Yeah.
I think you're and a lot of people are gonna, but your ceiling in Berwyn should be like 395, 400.
Yeah,
Or
I mean-
Maywood's 320. Look, Maywood's 325, 330 for a renovated bungalow, 350. Berwyn should be 5% above that, right?
Yeah,
Not-
5-10%, maybe even 5-8%
But you
above
shouldn't
that.
be seeing stuff in Berwyn because look, there's no real town like you have in Western Springs or LaGrange or Glen Ellen or Elmhurst. The schools aren't stellar rated,
Correct.
right? It's a market that you shouldn't be in Berwyn expecting to pay 600,000, 550 and expect those values to sustain. It just doesn't make sense. And that's why you're seeing Berwyn and Cicero happening what happened.
Adjusting. And that's the part of it that you have to, and especially if you're an investor, right? This becomes important. You have to start looking at future pacing the market.
And
Right.
from an investor, a lot of people in real estate were trained, hey, your comps are what closed. No, your comps is what's active today.
Correct.
Because the market's shifting. So what closed six, you can say, man, this guy got 450 for this bungalow here in Burr. I got the same house. I could get 465. No, the market's going backwards.
Right.
So what's your pending inventory at? What's your market time on your active comps? What's under contract and what are those selling at over the past couple months from under contract to sold to try to justify where you're going moving forward?
Correct. It's because it's saying that, and this is what happens a lot to people. They'll look at 1.5 prices, right? Man, this property, my friend sold it for $500,000, a bungalow in Berwyn. I mean, there were sales at 520, 530, right? That property today, guys, is going to realistically sell maybe 430, 440. Right? And people are like, that doesn't make any sense. 100,000 property. No. It was just the right time. It was a bunch of factors that lined up. And maybe the actual value was 440, 450, 460. But because of the crazy interest rates, craziness going on in the market, right? People were getting 510, 520, which is not a realistic number to begin with.
No.
You can't buy based on that.
You shouldn't see those numbers in these markets, right? The foundation of this market remains the same, right? Your
affordability.
Your schools are C-rated schools. You don't have really you have shops coming in and out, but you have no stability in your economic development. So like these values, you shouldn't see them continue to rise. Now, where if you buy in Downers Grove, the schools are good.
Right.
You have a downtown that's thriving every day. They're building more and more into it. The village is finding ways to enhance their community, and you're going to reap those benefits.
Correct.
But a lot of these C markets, you're not seeing that. So the value should never, there's a ceiling. There really is. You're not going to tell me if you buy a house today in Berwyn for $600, that in 5 years that's going to be worth $950.
Right.
It's not going to happen.
Right.
Could it happen in Downers Grove? Yes.
Yeah.
Could it happen in Elmhurst? Yes. Yeah.
Because, I mean, it's very simple, right? Employment, schools, affordability, all of those things are there. Right. And just because and that's the part of it. A lot of times, I don't think people understand the market, right? Or they don't pay attention to, and they just look at what is happening. Actually, somebody recently I was talking to, they're like, Andrew, man, I bought this property, and but you were right. And I'm like, I have no idea what you're talking about, right? So he bought the property based on $500,000 in Berwyn. I'm like, listen, man, it's not going to sell. I don't care how nice you make it. Number one, do not finish the basement. There's no reason. It's a huge bungalow.
Yeah.
Just finish main floor, upstairs. That's it. He's like, no, if I finish the basement, my friend said I'm going to get more. I'm like, believe me, you're not going to get more.
Right.
It's going to cost you 30, 40 more to finish the damn basement.
Yeah.
And the house is so big. 2,200 square foot. Why do you need a finished basement there?
Right.
You don't, right? And he tried to market 500, didn't sell. Then came down to 480. Now he's finally got a sale at 435.
And he's going to lose on it.
And he's going to lose on it.
He's probably got private money behind it.
I don't know what he has. I think he has hard money.
Yeah.
Right.
So
somebody because we said no to private money.
Yeah.
Right. Because we're like, hey man, this is not realistic. Right. What you're pinning the property on, it doesn't make any sense.
And that's one of my look. I'm a big advocate. I'll openly say I'm very, very cautious and hesitant to accept hard money offers.
Right.
I want 10% earnest money. I want a 21-day financing contingency, and earnest money is non-refundable. People say, well, why are you so hard? What you just said, you said no to a hard money deal. 90% of these hard money lenders, now there's some good ones. Renovo, Jesse from your guys' team, Finance of America. There's some guys that know what they're doing and they're vested in it. There's for every one good one, there's 100 fly by night. Buyhomes.com gave me a pre-approval. My point of that is they don't understand the ARV numbers and they don't understand the rehab numbers. And a lot of these agents who are representing these investors don't understand the process either, right? So the renovation numbers are the buyer tells his agent, I can do it for 60. It's really 120. The buyer's agent says the house worth 600. It's really 500. When you come to the closing table, that deal is not going to come together because it doesn't make sense. So we see a lot of fall through with hard money.
Right. And that's where the people have to be careful. This is where, guys, it's called investing, meaning you have to understand the market, right? What is the market doing? Not 6 months ago. What is it doing today? And how many properties do you have active?
Right.
And how many properties are pending and in what price range? Right. Because that makes a big difference.
Huge
also,
difference.
Right?
A healthy market is 3 months of inventory.
Right.
That's a healthy market. A lot of these markets we're seeing 5, 6, 7 months of inventory.
Right.
Now some we're seeing 1 to 2 months of inventory, right? So look at your months of inventory in that market you're in and the price, where you pricing at versus, I look at often, hey, look, there's a gap between 120 and 150. I really would gut this at 125, but you know what? There's a big gap there.
Right.
There's no homes in that price point. Let me try 140.
Right.
Because that's very important. What's active? There's always going to be gaps within the pricing market. When I say gaps, like I said, there might not be anything from 120 to 150. There might be 20 homes at 175.
Right.
There might be 10 homes at 95.
Right.
But the ones at 175 might be comparable to yours. So come in a little under it.
Right.
And move the market. A lot of people try to catch a market.
Right. No, it's so true, especially when it is a soft market, right? And guys, listen, again, a lot of times where the market is, right?
Yes.
But you can miss it. I mean, I missed the market on a property in South Holland where we overpriced it a little bit. Hey, let's see if we get it, right? And guess what? We still have that property sitting.
Yeah.
Rest of all the properties, we priced them correctly, a little bit, and boom, right? They go under, and this is really something you have to the market. I think what is interesting is the market's been so good for so long that a lot of people are like, oh my God, I don't have to do any homework. I don't have to do any research. I can just do whatever I want.
Yeah. And when it comes to pricing a property, the market is always going to dictate the value of the house. Right. Meaning, if you feel your property is worth 175 and you list it at 155, if that property is worth 175, guess what? It's going to sell for 175 because you're going to get the interest at 155 and people are going to bring the property up. A lot of people say, well, I don't want to list it low because I'm going to leave a lot of money on the table. You're going to leave more money on the table by pricing too high and chasing the down market than pricing a little more conservative and letting the market push you, because if that's really a 175 house and you go on the market at 154.5, you're going to have 60 showings in the first 3 days. And what do you always say? Showings to offers.
Yeah, showings to offers. I mean, to me, for every... And now, again, it's going to depend on the market.
Right.
It's going to depend on... I mean, if you're in Elmwood Park, if you're in some of those properties, some of those areas, right, you're going to need less showings. Yeah. So you have to understand, hey, how many showings do I need on an average? Right? I mean, that's where it really boils down to that a good agent who's honest with you, right? That's the big thing. Right? Yeah. A good agent who's going to be honest with you, that really understands that market and really knows that market is worth their weight in gold.
Yeah.
Right.
And that's a lot of my peers, my industry peers, and it's just like they're worried about this big number.
Right.
They don't want to hurt your feet. Well, I can't tell them that I won't get the listing.
Right.
I'd rather see agents tell them the truth.
Right.
And if they don't get the listing, that's the seller's fault.
Correct.
And the seller could deal with that.
Right.
Versus seeing an agent take a house and list it for 3-4 months, 30,000 too high, and do all this run around, it's never going to sell.
Correct.
Be more realistic of the market.
Absolutely. No, I mean, that makes sense. So let's say somebody wants to acquire yesterday, actually, you sent a property. I thought it was pretty decent. And so I posted it in Mastery for people that, hey, possibly, I haven't looked at it, but possibly it may be something worth looking at.
It's Mount Greenwood one.
I think so.
Yeah,
I think so.
Calls, yeah.
Right. And so how does the process work? Right, I want to work with somebody like you that has a lot of inventory from time to time, and it's not like all the time. How does the process work?
Yeah, I carry anywhere between 35 and 50 listings at all time. Right now, I'm probably about 42, 43. because it's a slower market, right? We're not
Sure.
putting as much on a contract. The best way to get a hold of us is email Ryan@SmithREO.com.
Ryan@SmithREO.com. Okay.
REO.com. You'll get on our email list. We'll send out a weekly list once a week, what's active. We'll send out an upcoming list. Once a month, I'll sit down and say, I'll review what I have active and say, hey, a lot of this stuff is starting to get aged. I can be a little more competitive on this.
Sure.
Give me let's talk about these. So we can help you in that aspect. We typically give you a heads up 2 to 3 weeks before we list it. If you're going to work with us, we can get you in there a little early. We ask that you do your homework. One of the biggest things with an REO is it's sold as is. It's sold as is. It's sold as is. What does as is means? As is means the way you see the house the day you walk it, that's how we're going to give it to you. Especially now we're going into winter market. We winterize all of our properties. That means the water is turned off at the house. The water is not on. If you go under contract as an investor, as is winterized means as is when you buy it and when you close it. We're not going to turn the water off for you.
Correct.
And understand that, and I say that because you have to do your diligence on what's wrong with the property. What's my worst? Underwrite your numbers right. The worst thing to me is getting under contract and then renegotiating afterwards or backing out because, the plumbing's not working. Now, if there's major defects, right, if you get up in the attic and all the roof trusses have mold in there or there's major cracks in the foundation, yeah, we can work with you. But know what you're doing when you're buying these houses.
Right. So if you basically, let's just say, go to a property, it's been winterized. It's basically nobody's been in it for years, 2, 3 years, 4 years, whatever it is, who knows, right? And then you're like, well, the plumbing is bad. Well, you have to assume the plumbing is bad.
You have to
assume the electrical is old. You have to assume those are just given. Now, unless there is something that is a structural defect that is hidden, right? Now, if you go there and clearly you see cracked foundation, right? I mean, it's visible, it's there, then it's as is.
Yeah.
Right?
Now, like if we have a basement and the basement's got drywall up on it and you get behind the drywall, we'll give you a short inspection period, but I also remind our investors and buyers, it's as is. You're doing this for your own general knowledge. We're not going to give you any money for things you find unless it's major, right?
Right.
If you get in there and you find the sewers collapse from the house to 50 feet to the street,
Right.
we could talk about something. We're not going to give you the full cost of the repair.
Right.
If a sewer costs $15,000, don't expect the bank to give you $15,000, $20,000. You're already getting a house at a value in the market, and sometimes we could split that cost. All right, we'll give you $7,500.
Sure.
Right? I've got a condo right now in the city under contract, 6 AC units in the condo.
6 AC units.
Penthouse condo, 6 AC units, rooftop AC units. We've got a cash buyer under contract. HOA disclosed, hey, the AC unit's got to be replaced. We get a bid for $47,000 and $62,000. We're not going to give all 47 to the buyer because the buyer's reaping the benefits of these AC units.
Sure.
Right? So we'll probably end up splitting it or doing a cost. That's probably what to expect on these REOs.
Got it. Okay. That makes sense. So how do you price a property, right? When a property comes to you, we kind of discussed this earlier, it has nothing to do with what it went to a foreclosure for. That has no bearing on what the property went to foreclosure.
Right. It's the fair market value of where it's at in today's market.
With that condition.
With the condition the house is in. So, like, for example, we'll talk about this bungalow in Maywood that I have coming up. It's a brick bungalow, 3 bedrooms, 1 bath. Attic is somewhat finished where, you got the stairs, you got a den and den. So they're not really bedrooms. Basement's unfinished. So I take a look at something like that.
North of the highway, south of the highway?
2011, so it's going to be south of the highway.
South highway, okay.
Yeah. So, and, north of the highway, the farther north you get in Maywood, the values tend to go up, and now the south side's starting to see high values too. So, so I'll take a look at something like that. Now, first, I'll look at what's out there active from an as-is standpoint, from value, and what's sold recently from an REO standpoint, right? And then I'll look at what the renovated numbers are. Then I'll kind of walk it backwards, right? I know the house needs windows, needs a roof, kitchen needs to be redone, floors need to be redone, plumbing needs to be. All right, that's going to be about $120,000 to renovate that house. So if it's selling at $330,000, $340,000 renovated minus $120,000, that gets me down a net of $220,000, $200,000. And then we'll put, I've got to equate for escrow from the village and put a little equity into it, and we'll try to get that as-is number down, to the 150 range. Got it. But we look at what a repaired value is and walk it backwards. but we also see what's as is on the market where there's a gap in the market. But they are priced on fair market value. Just because it's sat vacant and for 5 years, don't think that the bank's been dying to sell this thing and they're going to take $100,000 on a 150 up. It's not going to happen. I mean, if the house is worth 150, that's what it's worth.
So just to explain that, let's just take a property, right? And let's say the back end value of a property is 400, right? That has nothing to do with what you're going to price the property at. You're going to look at the condition of the property,
Right.
the way you get it, right? So you look at the property, it needs a lot of work, let's just say. And you're going to look at other properties that are sold that are kind of similar, that needed a lot of work. And then your job as an agent is try to get the maximum value for the bank.
Maximum value for the bank, yeah.
Right? And then you're going to price it. And so the price may be 250, maybe 200. It's going to depend on the condition of the property that you think you can get.
Right. And I do look at the renovated house because I know your mindset, and a lot of the buyer's mind says that's where it's got to be. So let's walk it backwards, right?
Right.
And look, in a market like Maywood, I keep going to Maywood because that's what we talked about. Look, there's not a lot of REOs on the market right now in Maywood, where 5-6 years ago, the market was probably 20% REO.
Right.
But there's a large appetite of investors out there wanting to buy value-add properties in Maywood.
Correct.
A lot of guys want to buy to keep their crews busy through the winter. They don't care about making 20%. Well, I keep my crew busy. I make $10,000. I got a good crew. I keep them. So that type of thing comes into play also, where that property's, when that goes on the market, there's no other value-add stuff. The market's going to push that demand up. I just had one in Maywood that I listed at 115, sold for 130.
Right.
Because the demand's there. So that comes into play too, but it's fair market value of where it's at in today's market.
Right. And that's the key thing that investors need to understand. Now, a lot of times what will happen is, or sometimes it will happen, depending on the market, right? You have a property, it's sitting on the market, doesn't sell, right? You think you priced it correctly. So how do you look at price adjustments? What is that based on?
So, I'll try to price it correctly, but we miss too. I miss sometimes, or what we'll see is the bank will test a little higher, and then we're chasing the market. So every 30 days or so, we look at activity, offer activity, showing activity, feedback, and we'll review the market, and we'll suggest reducing the price to the bank every 30 days. Once property gets around 100, 120 days, it becomes what we consider aged. We've been carrying the property longer than we want to. We'll have a little more leverage on pricing and offer activity than 100 to 120 day point. There's been a lot of times where I'll get a house in and I'll call Angela and say, hey, man, I listed this thing at 150. And she's like, man, that thing's worth 110, but you're way too high. I said, let's see where we're at in 90 days. Just hang tight. We'll see what we can do. And we've got them. 3 months later, you're patient. They'll test the market at 150. We'll drop it to 139. We'll drop to 132, and we're not getting the offers. And then we'll be able to go and say, 90 days, how's that 115? You still want it? Yeah, I'll still take it. And we get to do stuff like that. To think I list a house, like I listed that one today, I think for 190 at market, Mount Greenwood. To call me and say, I'll give you 140 for it. It's been on the market for 1 day.
Right.
Let me see the activity. Let me see what I can do. If it doesn't go anywhere, I might come back to you in 3 months at 140. But
yeah, and the price, maybe you want 140, maybe the price is 160 in 2 months, right? I mean, who knows? But it's going to depend on what and there's this crazy idea sometimes, people are taught that, the bank just needs to unload. I don't know who they're talking to, right? They just don't understand how the real world works.
I think that came about in the 80s where people would walk into the local Bank of Lombard, and the guy at the bank would say, I got these 3 houses. I got to get them off my books.
Yeah, exactly.
This is a multi-trillion-dollar financial industry. There are no books. No guys sitting with an Excel spreadsheet.
Yeah.
We got these 4 properties in Illinois.
That's not how it works.
No.
There
is no books they need to get off of.
No. This is not how it works. It's what is the market doing? What is the supply and demand? And what can the market bear? That's just, that simple, right? That this crazy notion of, I'm just going to make a ridiculous offer and I'm just going to get the, and sometimes you do. What is the difference between a pro investor or somebody who's really astute? They understand how these nuances work, right? A property let's just say has a cinder block foundation. Cinder block foundation messed up. for normal investors, that may be a big deal, right? And that's something that they can't address.
Right.
So then it becomes that, okay, you have to have somebody who specializes in something like that. And so you may get a good discount on that, right? But then it depends property to property.
Yeah.
So they reach out to you. What is it that they need to have in terms of buying a property? Do they need all cash? Do they need private money?
No.
Do they need hard money? What do they need?
Look, you've got to be qualified, right? And when I say qualified, cash is always easier to deal with. Private money, hard money with a vetted lender,
Right.
somebody that I know knows what they're doing on the hard money side. And I might ask you for your repair, but let me see. I don't have it yet. Well, what are your repair costs, right? And I can find out right away. If they tell me 60 grand to rehab the whole house, it's not going to work.
Right.
And, do your homework on the hard money. We'll look at it. LLC docs, proof of funds dated within the last 30 days, and ability to close quick, right? This is a numbers game. It's a speed game. Look, we do a lot of volume, and we do a lot of volume because we move them fast. We turn them fast. There's no waiting for you, because if you want it, 10 more people want it.
Right.
So, yeah, and the best thing, look, like anything in business, stand behind what you're going to do. If you go on a contract on a property, close on the house. Right. So many people try to renegotiate something like this. We don't want to do it.
Right. No, that makes perfect sense. So number one, if you're going to buy it in a LLC, have those docs done,
right,
ready.
Right? And I say that because, I'm sorry to cut you off, but a lot of times people will wait until, I'm buying 1201 Main Street. Did I get the house on a contract? All right, let me start the LLC docs now, right? Well, the seller needs the LLC docs to sign the contract. And it's going to take you another week to get that LLC form, get the corp doc. Have an LLC already established. If you want to quick claim it afterwards to that properties or do a series, fine, do it afterwards. But don't try to do it after the offer was accepted. Right. And we don't do assignees either.
Right.
We won't do an assignee
account. No assignee. Okay. So basically, just this, a lot of times people are like, well, or assigns, they're going to put it in the contract. They're like, but I'm going to wholesale and I've done this and that. That's not how a bank is going to accept it. That's it, period.
Right.
Right. You buy it. After that, what you do is none of their business. Right. They don't care. But you have to buy the property. Right. Mm-hmm. And there's ways of doing it. It's not like you can't do it. It's just that you have to understand the process. Right. Number one. Number two, what about proof of funds? Right. So let's say somebody has a proof of funds from a good hard money lender.
Yeah.
Somebody that knows what they're doing. Yeah. Is that okay with you?
I'm fine with that. As long as the hard money lender knows what they're doing.
Right.
They've done some projects with them in the past. They've got a track record. The hard money lenders that scare me is, like I said, fliphomes.com gives you a pre-approval because you watch an infomercial at 1 a.m. Sure. They're out of North Carolina. They don't know anything about Chicago. Right. But your local guys, your guys, National RE Fund, the Limas, the Renovo, they're here. They have boots on the ground. They know what they're doing. They can get to a property. They can clear them a lot quicker than these national guys that scare me.
Makes sense. So as far as inspection period, right? Do you give any inspection period? Obviously, you're selling the property as is.
Typically, I ask for no inspection period. And the main reason why is if I'm in a multiple offer situation and you say you'll waive inspection, it helps you a little bit. Like some things to help you is 10% earnest money. Say, hey, look, I'll make it non-refundable. No inspection. Now, we can give you an inspection period of 3 days, 5 days. We really don't like to do 5 days, but 3 days on cash or hard money. And again, we'll tell you it's for your own knowledge, right? But if you waive your inspection, it helps you stand out.
Got it. What about attorney approval? Like in the Chicagoland area,
5 days standard. Approval. I mean, we'll do an attorney approval thing all the time. Tax are prorated at 100%. We're not going to give you 110, 115% tax proration. You're paying for the survey. The bank's not going to give you a survey.
What about, like in Chicago, I know on some properties, there can be a terribly large water bill. If there is no meter, how do you handle that nowadays?
We pay the water. We'll pay the water.
Okay. So you'll basically, so if they put a water meter on there, whatever the past stuff is, that'll get cleared up.
Yeah, our water certs, when we get them back from the city now, that might be a delay if you're buying from us, because if we get a water bill back at $14,000 from the city and they didn't zero it out at foreclosure sale, we'll go back and fight the city, and that might take a little bit of time because the city of Chicago is supposed to zero the balance out at foreclosure.
Okay, got it.
Water doesn't Water transfer stays with the owner, not the house in Chicago. Meaning, if I own a house and I foreclose on it, and Andrew comes to buy it, he's not taking my water bill over. That foreclosure deed wipes out the balance of the bill.
Correct.
City's not the best at updating that.
Right.
So sometimes we'll get into a delay where, and we won't know till the day or two before the closing. We got to fight this, sir. We might need a couple more weeks.
Got it. Okay.
But yeah, the meter, we'll give it to you with a clean title, clean water bill. Zoning certification in the city of Chicago, single family zoning, if it's a single family home, be okay with closing with a zoning affidavit certificate. You don't need the full certificate. Multi-units, I would wait for it, but if we're trying to move it around, we'll ask you to sign a zoning affidavit, which means you understand it's single family, it's going to come back as a single family. It can't go lower than a single family, right? We're not going to give you a land zoning cert. Where if it's 2-3 unit, wait for the cert.
Right. Okay. Got it. So that's, I'm trying to think if I missed anything else. And then if somebody does a home inspection, that's okay with you.
I don't care. I don't want to see it.
Right.
Myself nor my clients want to see it.
Right.
And we don't want you, like I said, we try not to have you ask for anything.
Sure.
There's major issues. Say the whole roof has termites, mold, things that I don't see, you don't see, and you're like, hey, I hate to do this. Can you work with me? Yeah, we could probably do that.
Right. Okay. But it has to be something substantial.
Substantial.
And
broken pipes, old windows,
Right.
an old furnace or old boiler. Like, it's as is, man. You can see all that with your own eyes.
Correct.
So, yeah.
Okay. That makes sense. Anything else that I may have missed with all the kind of things we covered?
I mean, I think we did really good on the market. I mean, I could get into more stuff about defaults and what I see happening, but
Actually, that's a good place to wrap up, right? Is that what do you see going into, we're end of 2025.
Yeah.
What do you see going into 26?
I see default levels rising. Illinois, we rank 4th in the country in new filings in foreclosures. Illinois does not have a lot of equity in their houses, and our filings are rising. I think it's 1 in every 2,600 homes in Illinois is in foreclosure or some state of foreclosure, which is in the top 5 in the country. I see that going up, and to reason we touched on earlier, property taxes, value shifting, things of that. We're a large FHA market, and you hear me say FHA a lot, but you don't have FHA in these other urban markets as strongly as you do in Chicago because the affordability is not there to use FHA. And lastly, in the default servicing world, people were, in the last few years, they've been able to remodify a mortgage every 6 months, right? So, and that means if I have a mortgage with the bank and I don't pay it, they've been more inclined to offer remodifications to give them a bailout since COVID, right? So you can remodify me today. In January 1st, you remodify me. I make 2 payments. In May, I miss my payment, and I can't pay anymore. Well, the servicer would remodify them again, and they would do it again. So people in the past 5 years have been having a remodified loan every 6 months or something like that. As of October 1st of this year, they're allowing HUD and Fannie Freddie are allowing 1 remod every 24 months.
Okay. So let's just break that down a little bit because that's a important, even I did not know that, right? So a homeowner gets themselves into trouble, right? They can't make their mortgage, right? And it's a Fannie Freddie loan, right? Backed basically for a home.
Which is probably 80% of the mortgages out there.
Right?
Yeah.
And so they ask for a remod, which is that, hey, can I get a restructured payment plan? Can I do something so that my burden is lightened a little bit? What was it previously?
They were doing them every 3 to 6 months.
Every 3 to 6 months, they would remodify.
And they would allow them remodify. I don't even know if they had a time frame, but if they came to them and said, hey, I'm in distress, I need help, they were incentivized to remodify them.
Right.
The servicing companies were incentivized by the government to remodify them.
Got it.
And that's one of the reasons you see the sales go down. If you pay attention to what's happening in the foreclosure sale, you'll see a lot of sales canceled.
Right. It's because of that reason.
It's because of that reason. They remodify 2 days before the sale. Hey, we're good. They'll make the first payment. They might make the second. By the third, they're defaulting again, and they remodify them. Once they restructure the loan to their ability once again. Servicers do that to get a credit with HUD. They get graces with the government.
Sure.
They get incentivized to do that, and it prolongs the process.
Right. And so it's just kicking the ball down the road. And now what's the deal?
One remodification every 24 months.
Every 24 months. So even in a place like Illinois, you're going to get foreclosed on before that.
Yes.
Right? Because now, do you see that on your end? Because what I'm seeing is that the properties are moving through the foreclosure process a lot quicker.
They don't have to, and I don't change of administration maybe. They don't have to be as forgiving with these people now.
Right.
And when they remodify, they lose money. It's a matter, they're losing money because they're still paying the taxes. They're not collecting money on their loan. So now once every 24 months, a lot of these loans that have been sitting in the sideline for the last few years, you're going to start to see them. Oh, they missed a remodification, foreclosure. Right. And you're going to see those numbers rise quite a bit going into the next year.
Right.
So that's where I think we're going to head.
Okay. So that makes sense, man. I mean, we covered a lot. This has been an awesome podcast. I mean, we meant to catch up. So moving into 26, right? You feel kind of the same market because with Realtor.com and all these kind of things, right? They drive me nuts because it doesn't matter what it is. Oh my God, it's going to be better. Oh my God, it's like nobody talks about the reality. What's your opinion?
The reality is there's not a lot of equity in these homes.
Right.
Stop looking at a national Realtor.com and stop letting the media and all these people tell you this housing market has so much equity. There's not going to be waves coming. Chicago doesn't have the equity.
No.
It does.
And it's the largest FHA market.
Largest FHA market in the country. You can't buy an FHA house in Miami, New York, Dallas, Houston. Dallas you might be able to, but Vegas, Scottsdale. And when I say you can't buy it, they have loan limits with FHA.
Right.
You can't surpass those. So we have a very affordable metro market. And our property taxes are killing people, man. We are one of the most screwed up states from a
property tax perspective,
fiscal standpoint in the country, right? So, look, values I think in the A suburbs they're going to stay strong because people want to leave the city,
right?
So there's still going to be a demand there. If you start to see the foreclosure activity rise as we predict it will, you're going to start to see a balance off in the as-is values. There'll be a little more inventory out there. Look, we need a healthy default market.
Right.
It creates a healthy real estate market.
Right.
People say, I don't know how you do what you do. It's a backbone of what we do. I mean, for mortgages. So we need that.
You think investor opportunity?
For sure.
Right.
Yeah, for sure. Because with more sales, more properties come, things of that nature. I think a lot of people don't realize how significant this property tax issue is that we're having here.
Yes. Oh no, it's man. I mean, this is something that I have, been talking about lately more so than ever because it scares me, man.
It's horrible.
I mean, I don't know how you have some of the suburbs where your value is barely 180, 190, and you have a $9,000 property bill. Right? That just doesn't make any sense.
There's some in Park Forest that are 10% of the value of the bills.
It's just
$12,000 a year on $180,000 house.
Right.
How? But I think that you're going to look. There's a huge, and I don't care what Brandon John says. He's going to try to do a head tax, a boat tax, a social media tax. At the end of the day, he's going to raise the property taxes again. He has to.
Right.
There's a $11 billion deficit from a pension program.
Right.
Where are they going to get the money?
Right.
Unless they bankrupt the city.
Right.
The property taxes are going to continue to rise in Chicago and in Cook County. And
right.
As more commercial leaves, the homeowners pay for it.
Right.
And it's going to push properties in.
No, I mean, personally, I feel there is a lot of good areas of Chicago.
Yeah.
Right? I'm talking about in the city. I'm not even talking about suburbs, where I think, excuse me, you could go and possibly buy properties that is a lot better than some of the south suburbs because some of these south suburbs are just out of control.
Yeah. And Harvey's going BK.
I mean, it's crazy.
Yeah.
It's crazy. I mean, I don't know enough about that what happens when Harvey does file BK. I don't know.
I don't know. They laid off 69 employees yesterday. Cook County is now their police force. I don't know where it goes.
Yeah. So, no, this has been a great discussion for everybody listening. You're listening to Andrew Holmes with Cashflow for Life. And we have Ryan Smith with Smith REO in the house today. The way to reach you is Ryan at
smithreo.com.
Ryan at smithreo.com. You can get on their email list. And guys, please like, love, share the podcast. That's how we get to grow. And if you have a great guest, we always want to have people who are in the industry and who are doing amazing things just like Ryan. And congratulations again to him, not only for being the number 1 REO agent, but number 4 in terms of volume in Illinois.
Trends, yeah.
Yeah.
Thank you.
So this is awesome. So hope you enjoyed, and we'll talk to you soon.